Welcome back to the Unusual Whales YouTube channel. Today we will be discussing multi-leg trades. We probably can't get into every little detail because there is so much, but I think this video will be quite informative. Alright, so a multi-leg trade is as it sounds, more than one leg. The opposite of a single leg trade, if you will. If we check out the option strategy page, you can see a lot of different strategies. Something like a long call, which is simply just buying a call, is a single leg trade. A call debit spread, on the other hand, is a multi-leg trade which involves buying a call and selling a call of a higher strike. This is an example of a multi-leg options trade. A covered call is a strategy in which you own 100 shares and short a call against those shares. This is an example of a multi-leg stock trade. You can also end up with a multi-leg trade by executing individual single trades. So let's say I open a long call in the morning. Later in the day I decide that there's value in turning my long call into a spread. I do this by writing a call of a higher strike than the one that I bought. I've executed two single leg trades, but the end result is that I have a call debit spread, which is a multi-leg trade. So just a little bit of nuance in the definition of multi-leg for you to think about there. Alright, so as this relates to Unusual Whales, if you open any kind of multi-leg trade in a singular execution, you will see it labeled as being a multi-leg trade. How it works is the exchange that executed the trade labels it as such using a trade code, which you can see here. And then on the Unusual Whales end, we either render SL or ML to simplify it. SL stands for single leg trade, so a trade that was done on its own, such as buying or even selling a call. MLO stands for multi-leg options trade, so something that involves two or more options, such as a call debit spread. MLS stands for multi-leg stocks trade, which is an options trade that is linked to stock. An example would be a buy right, which is when you buy 100 shares and write a call against those shares in a singular execution. Keep in mind that similarly to any options trade, we don't know for certain if the stock involved is being bought, sold, bought to close, or whatever else it may be. Multi-leg options trades receive an icon with arrows, and multi-leg stock trades get this circular looking thing. You can click either for more information on potentially linked trades. Please note that nothing expressly labels any trade as being linked to another, but you can sometimes reason by qualities like the size and time of the trade to associate one with another. So if we read this VSCO trade at face value, looks like maybe a debit spread on the 19 and 25 strikes, as well as a short put on the 13 strike with the same expiration. We know all three legs are being opened for sure, given the relationship between the volume and the open interest on all three contracts. In the case of multi-leg stock trades, the related stock trades will only be available if they were executed on a NASDAQ exchange. Another way you might interact with the concept of multi-leg trades is through the contract charts and historical volume and open interest data. The percentage of contracts that were multi-leg trades for any contract is shown here. This is invaluable information. Multi-leg trades aren't a bad thing, they just need to be looked into a little further. Like here, we see 28,000 bid side calls on a gold ETF, so that alone sounds bearish, right? But quite literally 100% of all activity today on this contract was linked to another stock or option. Clicking the candle will take you to the flow for this specific contract for this specific time period. So let's click into the multi-leg icon to see potentially related trades. So it's actually a 5-legger trade. And if you look a little bit closely, you see what looks like a call spread getting rolled into another call spread. So we have the March 14, 270, 290 call spread. It looks like it's being rolled to the 275, 290 call spread expiring in April. while also potentially shorting a put to finance the trade. From this view, you can also manipulate the contract charts, so you can potentially see when this trade started. So we have pretty similar volumes on February 5th. So probably that was the entry point for this original call spread here. Definitely covered a lot in this video, so if you have any questions, feel free to drop them in the comments. Until next time, good night and good luck.